Well, you've probably been reading the headlines that the bear is coming. And indeed, it is. Something I've been talking about for many, many years. We knew that the bear would come. We didn't know when. So, should you be worried? Well, no. If you've heeded my advice, diversified your portfolio, set aside a cash reserve, you can actually stop listening right now. For everyone else, the answer is, well, probably not. We've been on the cusp of a bear market for several weeks. And this bear market would be the 29th bear market in US stocks since 1929. Because of the media's fixation on stock markets, you probably haven't heard of the bear market in bonds, which is the first since the 1970s, and by some measures, the worst bond market returns since 1842. Interest rates have actually been in a huge bull market for 50 years, which means interest rates have steadily fallen. That trend is reversed now that they're rising and bonds have entered into a bear market. The prevailing emotion when any market is falling is likely to be anxiety. The cause of anxiety is a feeling of worry, nervousness, unease, typically when we anticipate a negative outcome to an imminent event or uncertainty. And that imminent event is imminent in our minds. What can you do if you're one of those folks feeling a lot of anxiety? First, acknowledge that whatever you're feeling, you are feeling. It's a fact. It doesn't help and is probably more hurtful to tell yourself that you shouldn't feel anxious over the decrease in your portfolio. There are a lot of reasons why a person may feel anxiety around a decline in value. Some could be anchored in unresolved trauma from past experiences that might have little to do with today's falling markets. So here's some additional information that might be of help. First, there isn't ever a time when we are certain about future prices and market trends. Any investment carries uncertainty, even if our brains don't recognize it. For example, even cash in the bank has fallen in value by over 8% from this time last year. What's that mean? Well, the same dollar amount in your account buys 8% less today than a year ago. Now, that money is most likely lost forever, unless we move into a deflation, which is highly unlikely. Investments in stocks, bonds, real estate, which are all down in dollar terms, down more than cash in the bank, right? They have the prospect of recovering their dollar and inflation losses. Cash doesn't. Ironically, many people don't believe their investments will ever recover to former highs, fearing that even stocks will become worthless and their portfolio losses will be permanent. Neither of these things have ever happened. They are remotely possible in the same way that it's remotely possible that an asteroid will hit the Earth tomorrow. It's far more likely that within a year or two, the market will again reach new highs. The bottom line reasoning then for anxiety is fear of being unable to pay for current or future living expenses. This is why that I recommend that especially retired clients' portfolios include a cash reserve large enough to cover expenses for 1 to 2 years. And, that's going to help them weather market losses. It's those who need income from their investments to pay their bills now, like retirees, who are the most at risk of locking in their losses. In the big picture, the S&P 500 remains still above its pre-COVID high in early 2020. That's something that could not have been predicted when the pandemic hit. The current downturn, however, is completely predictable. All bull markets have eventually become bears. And then, at some point in time, they turn back into bulls again. So, I can predict right now there is a coming bull market. We just don't know when. Even if most people believe this historic data, we probably would not see an end to anxiety. I suspect that anxiety like this is part of the human condition. Yet when it comes to market turbulence, the most effective way to reduce anxiety may be an appropriately diversified portfolio. Thanks for listening.